Welcome to our presentation on the U.S. monetary system, the quick and easy version, part 1, brought to you by rebelcapitalist.com. Now don't worry, this is not a college lecture or a high school lesson. These are just factual tidbits that may be interesting to you. We do hope that people learn at least one thing from this presentation. So what are we going to cover today in part 1? We're going to talk about what is money. The history of U.S. currency. This is particularly important because it gives us some context as to where we are today. The gold standard and the U.S. dollar, specifically the value of the U.S. dollar. So let's start. What is money? Money is a method of exchange. Now think of this. Before money or currencies, there was essentially a barter system where people exchanged goods for goods or services for goods or even services for services. We have to think of money more than just the Benjamins. Money, Benjamins, and I mean for those who are not up on the current vernacular, is coins and dollar bills, hard currency. We have to think of it more than that because money includes the hard currency, but it also includes demand deposits, like our checking accounts, money market accounts, and certificates of deposit. And interestingly enough, our hard currency, our coins and dollar bills, make up a small portion of our total money supply. So when you hear in the news, you hear about the U.S. money supply and whether it's tightening or loosening, what they're talking about is just this broad definition of money. And it includes your checking account, my checking account, our money market accounts. The history of U.S. currency. And, this is brief, but I think it's interesting and gives us some good context. In 1775, the Continental Congress issued a paper currency known as the Continental to finance the Revolutionary War. It was backed by anticipation of future tax revenues. And this is where the problem was. So basically what they said was, we're going to issue this paper currency, but we're going to back it up with the thought that we're going to collect taxes from people sometime in the future. Needless to say that the Continental didn't last long because of the insufficient financial backing. So in 1792, the Coinage Act, and I believe this was brought about by Alexander Hamilton, created a U.S. monetary system. Now, starting in 1792, approximately through 1873, the U.S. dollar was tied to and backed by silver and or gold. So in 1861, U.S. Congress, in order to finance now the Civil War, authorized demand notes in denominations of $5, $10, and $20. Then in 1862, U.S. Congress discontinued those demand notes and issued what were called legal tender notes, or U.S. tender notes. These notes were the first national currency used as a method of exchange for most public and private debt. What's important to understand here, during this time, what was happening is that you had all these state chartered banks and unchartered banks issuing their own currencies, their own notes, redeemable in gold or something of value. So you had all of this paper out, this paper currency out there, these tender notes. And, it was probably not very good for the economy, so the federal government stepped up and said, okay, enough, we need to have one national currency. In 1863, the National Bank Act established a uniform national currency that was issued by these new national banks, and the currency was called national banknotes. These national banknotes were backed by U.S. government securities. Let's jump ahead to 1914. What we have in 1914 is the new Federal Reserve Bank, which was created by law. And one of the tasks they were given was to maintain our monetary policy. So they issued the Federal Reserve notes. They were issued in denominations of $1 to $10,000. Can you imagine holding a $10,000 bill? So what happens, we'll jump ahead to 1969, all notes greater than $100 were retired because of declining demand. That's very interesting. The gold standard. Now, the gold standard is certainly not something that we talk about on TV and commercials. The gold standard is a system where international currencies were tied to a specific amount of gold. The value of a currency was supported by our weight in gold. And we hit upon that in the previous slides. So in 1834, the U.S. begins conforming to a gold standard. The Coinage Act of 1834 pegs the U.S. dollar to 1 ounce of gold worth $20.67. In 1900, the Gold Standard Act settles any questions about the U.S. adopting a gold standard. So, again, there was some confusion as to whether we, officially adopt the gold standard, and so the Gold Standard Act put any questions to rest. I mean, it officially adopts the U.S. officially adopts the gold standard. So, after World War II, the gold standard system was modified, and instead of having international currencies backed by gold, what you had was the international currencies were actually backed by U.S. dollars, and then the U.S. dollar was supported by gold, and at that time it was pegged at $35 per 1 ounce. Needless to say that this modification to the gold standard meant that the U.S. was the center for international currency exchange. Then in 1971, with the Vietnam War, high inflation, and a supply shortage of U.S. gold, President Nixon abandoned the gold standard. And so what do we have today? We have a U.S. currency that is not backed by any physical commodity such as gold or silver. And the value of the U.S. dollar is determined by the market, by the actual supply of money and the faith that the currency markets have in its strength or weakness. I mean, either the markets believe it's strong and will build up a value, or they think the U.S. dollar is weak and will not purchase U.S. dollars. So where are we at today? Where's the U.S. dollar today? Well, the U.S. dollar can be summed up, the value of the U.S. dollar can be summed up in one word: weak. We have a graph here that's comparing U.S. dollars to 1 euro. So this is basically saying how many dollars would we get for 1 euro? Euro being the European Union's official currency. And this graph shows the value of the U.S. dollar has fallen compared to a 1 euro over a 120-day period. So I think, as the graph says, the latest, it's September, and this was September 9th of 2008, we could get $1.41 for 1 euro. So what this means is, if anyone had the opportunity of going to Europe recently, they would have noticed that they weren't really able to get much for their dollar. Okay, this is the end of part 1 of the U.S. monetary system. Thank you for your attention. We hope to see you at rebelcapitalist.com. Have a good day and good luck.